Hello, welcome and good morning to everyone, and welcome to this webinar organized by the Spain-US Chamber of Commerce. We are happy to have you today to discuss about a channel for investment, and we are really excited to have one of the leaders in the industry to talk about that. But before I introduce our speaker of today, I just would like to remind a few things. So for those of you that don't know the Spain-US Chamber of Commerce and it's the first time that you join one of our webinars, just to say that we are a non-profit organization, an official binational Chamber of Commerce that fosters businesses between Spain and the United States and offers support and guidance to companies and entrepreneurs interested in developing their businesses in the United States and also in Spain if needed. We are based in Miami, Florida, but we can support companies in all the United States. We host many different events during the year, trying to cover the main topics that are of interest of the community. That's why, like today, we are covering a topic that we believe that it's very interesting and that the people ask us many times to learn a little bit more about that. So I encourage you to visit our website where you might be able to find all our services and all the activities and events that we are hosting. Our website is very easy, it's just www.spainuschamber.com. You will see that right away in our chat here. And about today's webinar, just a few housekeeping comments. We will have this presentation, and after the presentation, we will open a few minutes for Q&A. So any of you that would like to send us a question or a comment, you will be able to do so at the end of the presentation through the question that it's in the control panel that you might see on the right side of your screen. There should be a control panel and you can find a tab that says questions. You just need to click there and write your question and send that question right away to us. You can send your questions during the presentations and we will address all of them at the end of the presentation. Also, we will share this video because this session is being recorded, and we will share the video, the presentation, and the contact information from our speaker today, just in case you would like to review that with your friends. Also, we will upload it to YouTube, and you can contact directly to our panelists of today. And without further ado, let me introduce you first the company that is helping us to put together this session, which is AmiCorp. For those of you that are not aware about AmiCorp Group, you should, because it's a company with presence all around the world. AmiCorp is a boutique provider of financial markets, funds administration, and corporate management services. They offer clients extensive interconnected support network of local and global market knowledge and expertise, particularly across emerging markets. Its services includes cross-border structuring, security issuance, trading, custody, and investment-related services, as well as regulatory and tax compliance support, and multifaceted business support alternatives for clients wanting to invest or expand internationally. So that's the reason why we called AmiCorp to talk about today's topic. And in particular, we are lucky enough to have Francisco Donada with us. Francisco is the commercial director of AmiCorp de España, which is based out of Barcelona office, where he plays a leading role in providing capital markets, wealth planning, and alternative investment fund solutions for clients. Prior to joining AmiCorp, he spent most of his career in the banking sector in Spain and Switzerland, focusing on corporate banking and private wealth. At Deutsche Bank, for example, and Credit Agricole, he participated in several syndicated financial facilities and capital market transactions for MNC corporates based in Spain. And as a private banker working for Merrill Lynch, Rothschild and Co. and Creant, he provided investment advice and wealth planning to high net worth individuals and family offices. So I believe that we have the right person with us today. So welcome so much, Francisco, for being with us today.
Thank you, Juan Carlos. Thank you to the Chamber of Commerce for your invitation. It's a pleasure for me and honor to be the speaker in front of this audience today. So let me thank you as well for the introduction about AMICorp. AMICorp, we are present in 40 different jurisdictions today. We have 30 years of experience and we hold more than 50 different licenses across different regions, and our activities based on 3 different areas, which are basically financial markets, fund administration services, and management services. Let's start the presentation. You can find more information on our webpage. The presentation today will be about funds. The presentation will have like 3 different parts. Okay, in the first part, I will provide like the big pictures about funds and why funds are so important today for the economy. Then on the second part, I will go through the regulation. I will try to not to make it very technical, but yes, to provide some ideas about how the fund regulation works in Europe. And finally, we will go through 5 different cases, practical cases, in which funds were used as a solution for different entrepreneurial projects that we'll see later on. So let's start with a big picture. So the presentation today is about funds. Okay, funds, I would say that it is part of a global trend, which we could name disintermediation. This is not something new, obviously. This has been here for many years in some cases. Disintermediation is the fact that banks are not anymore in the financial industry, let's say the monopoly to channel savings into investments. Okay, there are other mechanisms, other instruments that provide a direct link between the investors and the corporates to execute the investments and the economic activity in the real economy. Some of these mechanisms has been out there for not only for years, but for even centuries, like the stock exchange. Some others are more recent. The more recent ones named here in this slide will be the crowd lending platforms, which are quite popular, but not so significant in terms of size. And probably the ones that have had more success in recent years in terms of size and assets under management are securitization and funds. Today, we will talk basically about funds. When we talk about funds, we have to differentiate 2 different types of funds, okay? The first one, which in Europe we call UCITS, are open-end funds. Open-end funds, as the name indicates, are funds in which the investors can redeem and subscribe shares at any time, and the fund will provide a counterparty for the investors, so they will provide liquidity. Therefore, the type of investments that an open-end fund will execute are liquid type of investments like marketable securities, listed equities, listed bonds, securities which are traded in a secondary market to provide liquidity to the investors. Closed-end funds, on the opposite side, are those which are, as the name indicates, closed funds. Therefore, the investors are not allowed for a certain period of time to redeem their shares. There's a period of fundraising that the fund is closed, and then starts a period which is called the investment period, in which the investments will be executed. Then these investments will be disinvested, and the funds will be returned to the investors after a period of 5, 10, 15 years, depending on each case, on a pari passu basis to all the investors at the same time. As a consequence, they will not have the same level of liquidity than the first ones, correct? The first type of funds, UCITS or open-end funds, are targeting basically retail investors. So they are more protected in terms of regulation, in terms of diversification, in terms of the type of assets that they can invest, and therefore normally the return and will be not as high as that can provide with the closed-end funds. Closed-end funds are targeting more institutional investors and professional investors who have the knowledge to understand this type of products, and therefore the rules that will apply to the investments will be much more flexible in terms of the underlying assets they can invest in, and in terms of the type of investments and diversification rules that they can have. As you can see in this slide, there has been an exponential growth. This presentation will be focused on the second type of funds that I spoke about in the previous presentation, closed-end funds or private investment funds, let's say. These type of funds are the ones that have been growing the most in the industry. The growth that they have had has been exponential, from less than 1 trillion, at the beginning of the century to 14 trillion. To put it in perspective, 14 trillion is the size of the US or the China economy. So it's quite a substantial size. If we consider that it has been growing from 1 trillion into 14 trillion in only these 23 years, that implies a compound annual growth of return of 14% every year, which is quite impressive. And still based on data provided by Prekin, which is a data provider, the expected size of the industry will be of 24 trillion by the year 2030. That still provides a growth rate around close to 10% in the coming 6-7 years. Okay, so we can see here the different segments of what these type of funds are investing. And how this has evolved in the recent years. So for instance, in the year 2000, most of the investments of this type of funds were dedicated to private equity investments, 85%, while currently private equity investments represents only 65%, so 20 percentage points less than at the beginning of the century. So other segments have been growing in terms of importance and market share when we talk about alternative funds or private funds. Like private debt, which probably is the one that is growing the most in recent years, infrastructure and real estate. In terms of return, as I said before, closed-end funds are expected to provide a higher return than open-end funds to compensate for the, let's say, the risk premium of being illiquid, of the fact that you cannot liquidate your investment for a certain period of time, correct? And it has been the case based on data provided by Prekin. The return that has been achieved in private capital funds in the last 10 years to the end of 2023, it has been 13.3%, being different depending on the asset class we are talking about. So the one that has provided the best return has been the private equity, but other asset classes, which probably a more conservative approach like private debt, infrastructure, or real estate, have provided returns close to 10%. We can compare that with a return obtained by the equity markets, for instance. So the MSCI World has provided in the same period of time a return of 9.2%, which it's a little bit, it's 4 percentage points below the return provided by alternative investments. In terms of the other data that can show the impact of this type of vehicles in the real economy is the data provided here. So for instance, in this graph, we can see the amounts of fundraising in different years. So for the last 20 years, these type of funds have achieved a fundraising of close to 11.5 trillion. This is quite impressive, and this means that it activates a lot of savings into the real economy, into real investments in infrastructure, real estate, or private companies, which is quite positive. This has been achieved mainly through the investments of institutional investors like private pension funds, public pension funds, sovereign wealth funds, endowments, or foundations, but more and more professional, high net worth individuals, family offices, or even retail investors are accessing to this type of investments as well. For the first ones, institutional investors, today it's quite common that in their portfolios they have up to 30% of their portfolios invested in this type of closed-end funds, which is quite significant, replacing the exposure to other type of securities. Other data that shows the impact of these funds is that 35% of the global M&A activity on a worldwide basis is now driven by private equity funds globally, and the fact as well that on the lending side in the US, up to 15% of the corporate credit today is provided by this type of funds, private debt funds, like the ones that we are talking about. So until this slide, we have been providing the big picture about the fund industry. Now we will go a little bit more into detail about the regulation of the funds. I will start explaining the reasons why to set up, what are the main benefits of an alternative fund on a global basis, not only in Europe. The first one, not the most important, but just to name one, it will be the tax planning. Okay. Normally these vehicles are quite efficient from a tax perspective, as we will see in different cases later on in another slide. But the basic idea is that this type of funds at least will provide to the investor tax deferral. Considering that this type of funds, what they want to achieve is the long-term capital appreciation, tax deferral is something very important to achieve. Otherwise, you will have to do some redemptions to attend the tax on capital gains that have not been realized. So the tax deferral will be always the first achievement that all the funds, all these type of funds will provide as a benefit to the tax investors. Although some investors, institutional investors, that they can benefit from other structures, these funds can provide as well tax transparency or look-through structures. Okay, so in those cases, the funds will be not taxed themselves, but the income will be transferred into the investors. That depending on their accounting rules, it will be beneficial for them. So it's quite flexible from that point of view. The other benefit of the funds is that they will provide flexibility. It can be set up as a private undertaking or as a collective undertaking. Although they were thought for collective undertakings, we can see in Europe many different structures that provide a private vehicle for a family office or an ultra high net worth client, and so on. It can be as well organized as a standalone entity, or you can as well create an umbrella with different compartments for different investors, and then in this way you can share some of the expenses on the directors or other structural expenses that could have. And this type of entities could have legal personality or no legal personality. It could be a fund, which will be like a community of assets without legal personality. In that case, the management of the fund will be outsourced to a third party, which will be the manager, the investment manager. It could be as well with legal personality. It will be corporate, and you will have your board of directors in the fund. But again, the strategy will be implemented by the manager. The setup can be quite fast. You can, in many of the funds, you don't require a pre-approval by the regulator in that country, but only a notification, because the one that will be supervised, it's the manager, not the fund itself. even if you want to go even faster, or even if the size of your fund does not justify a licensed manager, you can create an unregulated partnership to start with, which is much more flexible and much more faster to go to the market for the fundraising. And then once the fund has grown, you can transform that unregulated fund into a regulated one without triggering a tax event. So that provides a lot of flexibility to the manager, to the investors. In terms of confidentiality, the managers are required to maintain the confidentiality of the investors. They will have to provide information to the investors, especially in terms of performance, but not the personal information about the investors. In terms of underlying assets, can be quite flexible as well. You can invest in private companies, in infrastructure, in startups, real estate, agricultural land, timberland, wine, art, or even in other funds like the ones we are talking about. So you can create a fund of funds as well. And the manager will provide an annual appraisal to the investors at least once a year. Why set up an alternative fund in Europe? There are different reasons. First, because it's a long-term solution. The European Union is considering this type of a structure as a privileged vehicle to channel investments, to channel savings into investments. One example for that is that the directive for the ATA 3, which is the directive that will cover the shell companies in Europe, has provided or has explicitly removed this type of funds from the scope. So they will not be affected by this new directive applying to shell companies. Because it's a well-established regulation. The Alternative Investment Fund Management Directive was set up in the year 2011 and has been transposed into all the different countries in the European Union. So provide a uniform landscape or framework in all the countries. Now there is the draft for the second directive that will provide even more benefits to this type of investments in terms of marketing for those fund managers who are not using this as a private vehicle, but to do a collective vehicle and to do fundraising. I think that this fund will be the best choice, but will allow you to make use of a passport and commercialize your fund in any European jurisdiction. You can create as well feeder master structures to onboard for those that have maybe a fund outside of the European Union and want to onboard investors in the European Union. You can create a feeder master structure that we will explain later on. And then you can as well do pre-marketing through this regulation. This means that before registering your fund, you can do a pre-marketing to test the appetite, investor appetite in the European Union, and based on their reaction of that pre-marketing, you can decide to move forward with the registration of your fund. The best in class, the funds are let's say, regulated on a local basis, not the manager. The manager is a uniform regulation across the European Union, but funds are different in each one of the country. So you can pick up those which are the most beneficial for your project based on the geography of your project, the investors where are located, the taxation, and so on. And then you can minimize your cost. I mean, what you can do as a manager, as a promoter of a project, you can rent the license, or even as a private fund from a family office, you can rent that license to a provider like AmiCorp, and then you can let's outsource the administration, the reporting, and everything. So then it can be most cost effective than if you have to do that yourself. Then very quick on this slide, as I said before, the regulation that will oversee the activity of the manager, it's an European one, so will be the same across all the European countries. However, the funds will be regulated on a local basis, as we will see later on. And then you can have regulated structures, regulated managers that will require a regulated manager, and those structures which are unregulated, like a partnership, and will not require a regulated manager as long you don't reach a certain threshold of 100 million euros. Obviously, you will not have some of the benefits like commercialization, distribution, or taxation for these funds. But as I said before, you can start with a regulated fund and you can transform that into a regulated one. You have escalate your fund and benefit from all the other things that they can provide. These are the functions that are expected to be performed by the fund manager, which is the most typical one, the portfolio management. So the implementation of the investment strategy will provide as well the risk management. This portfolio management can be outsourced to a sub-advisor. So the sub-advisor will provide recommendation to the manager that will then implement after. Then you can, it will have to do as well the risk management, the administration of the fund, which is basically the accounting and the reporting, and then the compliance, which is the onboarding of clients, AML, anti-money laundering regulation, and so on. And then there are other auxiliary services like advisory, portfolio management, and custody. In terms of taxation, I will provide a very simple picture about the taxation of the funds. Okay, I will focus only at the fund level, not at the investor level. The obligations of the fund will be the ones that I explained here for three different type of funds. I choose three: the Spanish SCR, a Portuguese fund, and a Luxembourg fund. The corporate income tax in Spain will be almost tax exempt. So the income will be taxed only at 0.25% for the capital gains, compared to the 25%, which is the normal corporate tax rate in Spain. So it's like to say that it's almost exempt. It is exempt in the case of the Portuguese or in the case of the Luxembourg. However, the Luxembourg fund, like the RIFE, will have a subscription tax, annual subscription tax of 0.01% of the assets, which is quite low. For instance, a fund with 100 million euros will pay only 10,000 per year, which is only 1 basis point of the value of the asset. In the case of the Portuguese fund, will be something similar, but it's called stamp duty rather than subscription tax. And then this will apply to the cash flow that it's received by the fund from the participating entities, from the underlying assets. In the case of the payments made by the fund to the investors, okay, they will be exempt of the withholding tax. Okay, so it will depend on the investor and his tax jurisdiction what he will have to pay, but at the level of the fund will not be obliged to pay withholding tax when they pay a dividend to the investor. So we have different type of funds based on country. As I said before, there are some of them which are harmonized at European level, which is the EUCA for startup companies, which is the USEF for sustainable investments, or the LTIF, which is the most recent one that provides a lot of flexibility. It can invest in other funds, and it can invest as well. It can be invested by retail investors. It's the only one allowed for retail investors. Then in Spain, you have basically the SCR or FCR, which is the Sociedad Capital Riesgo, Fondo de Capital Riesgo. In Portugal, you will have the OIA, which is Organismo de Inversión Alternativa. You have different ones depending on the underlying assets for real estate, venture capital, or for private debt. And in Luxembourg, you will have the RIFE, the SIF, the SICAR, being the RIFE the more flexible one in terms of authorization, in terms of underlying assets. Then let's go just to provide some quick ideas for each one of them. So for instance, I selected the three that for me could fit better for for investors. This is the OIA de Capital Risco in Portugal, OIA of venture capital. This was it expects to invest in startup companies, let's say growth companies, but it can be used as well for real estate investment as long there's an activity associated to the real estate investments. So for instance, it's commonly used for investments in the hospitality sector in Portugal, because it's a way that you will avoid a 10% withholding tax that will apply after some changes in the rules in Portugal for real estate type of funds. The reference period for the investment holding is 12 years, but it can change. You can define a longer period for the underlying assets. You can provide as a manager as well consultancy and assistance to the investing company, to the participating companies. You can invest into the assets in equity, debt, or participating loans, or you can invest as well in other similar fund structures. The diversification rule is quite, let's say, allows quite a high concentration of the assets. So the maximum holding is in one single asset is 33%. This means that you can have a fund with only 3 investments. Then you can have as well listed companies as long you have a 10% ownership. And in case that 60% of the assets are invested in Portugal, you can the investor could qualify for the golden visa as long the investment exceeds 500,000 euros. Then the SCR in Spain is quite similar in terms of the underlying investment. You can invest as well in hospitality. You can provide consultancy services to the participating companies. You can invest through equity or debt. You can have up to 40% of the fund invested in non-qualifying assets like deposits or securities or other type of investments that do not qualify. And one important advantage is that you, on top of the tax advantages that I mentioned before, you can be exempt on the wealth tax or the inheritance tax, which in Spain is a big advantage, as you know, especially since the new tax Impuesto a las Grandes Fortunas was in place a few years ago, which applies as well to non-resident investors. Then the other entity that could be quite interesting for the investors is the Luxembourg RIF, because provides a lot of flexibility in terms of investments, and because it's the one that can provide structures like an umbrella with different compartments. So it's quite interesting from that point of view, because you can share the different expenses with the different compartments. The main advantages is that do not require the approval from the local regulator, the CSSF in Luxembourg, that you can have this umbrella structure with different compartments. And the only thing is that it has to be a regulated manager that will manage the platform. Then we have finished now that part dedicated to the regulation. We will go through different business cases that I will explain. So in this case, it could be a real estate developer in Miami. They have a lot of expertise and track record doing investment in hospitality in Florida, for instance, and they want to expand geographically, and they have, let's say, observed a business opportunity to invest in Portugal. So they could, the investors, they could do the investments in Portugal through the setup of OIA of venture capital of a fund in Portugal. They will do the onboard of investors in any European jurisdiction. They will invest in Portugal, and because the investments will be made in Portugal in some different touristic spots like Comporta, Algarve, Alentejo, they will benefit, the investors will benefit from the golden visa if the investment is above 500K. And they could, I mean, this promoter in Miami, to avoid all the burden that implies the regulation, they could, let's say, outsource the manager and the administration to a third-party provider like AmiCorp, but they will keep the investment strategy for themselves with a sub-advisory contract with the manager. Other example could be an SCR in Spain, for instance, let's say an investor who is expert in green energy projects, like green parks or solar parks, and they want to invest as well in Europe, for instance, in Spain, to benefit from some of the many subsidies that this type of investments have in Europe recently. So they could use the license to pre-market this business opportunity before launching the fund. So they could commercialize before registering the fund among the investors. They could apply as well for Article 9 of the SFDR directive in Europe, which implies that this fund will be considered as a sustainable fund for investments, which is really helpful on the fundraising to those investors who are sensible for this type of investments. And investors holding more than 5%, they will benefit as well from the exception in the wealth tax in Spain that applies to otherwise to other type of investments. Then other potential business case could be a US entrepreneur who wants to have a private vehicle to do investments in Latin America in different fintech companies across Latin America. He could set up again an SCR in Spain and this fund will invest in different fintech companies in Mexico, Colombia, Brazil, or Argentina. He therefore will benefit from double tax treaties between Spain and these countries, as well as some protection treaties between Spain and these countries. The upstream of cash, therefore, from the participating entities into the fund will be low tax, as we saw before in the previous slide. And he could remain as a private vehicle in which he will decide the investments, providing recommendation to the manager of the SCR. Other possibility that can be a solution using this type of funds is, for instance, a VC manager in the US who has a fund in the US or any other jurisdiction outside the European Union. He has been very successful, so he wants to market his fund in the European Union. It will be quite complicated if the fund is not registered in the European Union. Therefore, what he can do is to create an SCSP, for instance, a partnership in Luxembourg. Okay, the SCSP will provide a lot of flexibility, so 100% of the assets of the fund will be the master fund of this manager in the US, and he will create this feeder fund in Europe. He will do the commercialization. He will onboard the clients in the investors in Europe through this fund, which is located in Luxembourg. So this will facilitate a lot for this manager to commercialize his fund in the European Union. He will not have to go through the private placement rules, which are much more complicated in terms of accessing and marketing the fund in Europe. And then one last case, this could be a RIFE platform in Luxembourg, in which this RIFE platform will be set up by AmiCorp. AmiCorp will provide the management license. AmiCorp will be as well the GP, the general partner in the fund, and then we'll create different compartments within this umbrella. These different compartments will be, let's say, owned by different investors. So for instance, in this case, a family office with hotels in Paris and London, he can appoint each one of these compartments could have a very different strategy, absolutely different one. They could appoint a different sub-advisor or even a different third-party manager, as this could be the case. So you can have an umbrella, but different compartments with different strategies. So how can AmiCorp can assist looking forward? We can, let's say, meet with the UBO and provide some analysis of the situation and see if the fund could fit on his strategy. We can create an action plan together with local tax advisors to know, to explain how the fund works, the taxation in Europe, but as well what will be the implication for the investor in the US. We can provide the license as a manager to set up the fund as a regulated fund in the European Union, and therefore to have the ability to get the European passport to commercialize the fund in any jurisdiction in the European Union. So we can facilitate the market or even the pre-marketing of the fund across the European Union, so he can test the appetite from the investors before registering the fund. We can provide the ongoing administration of the fund, accounting, reporting, NAV calculation, and so on, compliance and risk management, and some other auxiliary services which are quite important today, like independent valuation and ESG ratings to comply with the SFDR regulation in Europe. So thanks for your patience. Thanks for your time. So now we can open the seminar for questions.
Yes, thank you so much, Francisco. Very interesting, and I really like those case studies, the different options that you showed us at the end, because that allow us to get a better sense of what can we do with several types of funds. So yes, please, we have already some questions, but all of you that haven't write before, if you like, if you want to send us a question, please do so just by clicking in the tab that says questions and just write there your questions and we will address them right away. Also, I remind all of you that we will share with all the attendees the video of the presentation as well, and the contact information, that you also can see the contact information now in your screens. So Francisco, first question that we got, and we got this question at an early stage in the presentation, probably when you mentioned about the different benefits, and you mentioned the first one, which was taxes. So the question that we have is FATCA regulation affecting these types of funds in terms of confidentiality?
Well, FATCA, obviously we will have to provide the comply, and in fact, Amicorp is one of the best experts in FATCA rules. We apply FATCA to all our clients when we set up different type of companies, and in fact, I mean, we will have to comply. I provided, in terms of taxation, I provided the view from the fund perspective. So it's important that we realize that these type of entities will provide an advantage compared to other type of entities and regulated entities, no, to hold assets not only in Europe but in any other jurisdiction. As long as there are double tax treaties in place, the fund will benefit on the upstream of cash from the participating entities into the fund. So the investors can then manage, as long as the cash remains at the fund level, they can reinvest and look for different options without having any tax event. Correct? Once the cash has been received by the fund, because it's a closed-end fund, the fund will be distributed to the investors. Then the different rules will apply for each one of the investors depending on the jurisdiction. What is true is that based on the double tax treaties between Spain and the US, it is expected that withholding taxes will not apply to this distribution into the US investors. But it's up to the US investor to have the information about how this distribution will apply to his personal tax income and report. We can obviously I'm based in Spain, but we can ask for the support from our AmiCorp office in the US. We have an office in Miami, and then analyze the situation case by case and see how this will impact the income statement of the investor. But what I can tell you is that at the level of the fund, you will achieve tax deferral and low taxation in most of these funds, unless you opt for a tax transparent type of entity in which the fund will not be taxed. So all the inflow, the upstream of cash received by the fund or the partnership because of a disposal of an asset or a dividend distribution of our interest payment or whatever will not be taxed. That income will be, let's say, assigned to the investor because the entity will be tax transparent.
Wonderful. Thank you so much, Francisco. Next question that we have here is, what are the main advantages and disadvantages of a regulated fund versus an unregulated fund?
Yes, the main advantages of the regulated fund is the fact that you can first you can commercialize the fund across the European Union openly. I mean, you can I don't know, organize an event in a hotel, I don't know, in Madrid or in Barcelona or in Berlin or wherever, and with 100 attendees, and present this investment opportunity. As you know, the investment advice in Europe is highly regulated. So everything that it's not, let's say, regulated, you cannot do a massive marketing of that opportunity. You have to go through the private placement regulation, which is quite strict, is quite limiting in reaching the audience, let's say. You have to do the marketing on an unsolicited basis, on a one-to-one basis. Therefore, it's much more complicated when you want to raise money in different countries. So that's one of the main advantages of a regulated fund. As a starting point, I mean, if you have your club, let's say limited club of investors already committed, and you want to start fast, maybe it's good that you start with an unregulated entity, a partnership, let's say, and then once you want to escalate the fund, you want to do a massive marketing because you have been successful with your investment strategy, then you can convert that unregulated fund into a regulated fund. The other advantage, depending on the cases of the regulated fund, is the tax treatment, because regulated funds will be taxed at the fund level, and normally at a very low tax rate, as we saw in the previous slides. So almost exempt in most of the cases, compared to the normal corporate tax rates between 20-30% in most of the European countries. So it's quite in that respect is quite beneficial because you are a low tax. And then, but if you want to opt for a tax transparent, then it's better an unregulated fund in that case.
Thank you so much. Thank you. Another question that we received is, could you please develop further on the tax advantages of a Spanish fund?
Yes, a Spanish fund today can provide another big advantage, not only those tax advantages that applies to all the funds in the upstream of cash from the participating entities into the fund and from the fund into the investors, but as well in other tax type of taxes. In Spain, as you know, we have a high rate of wealth tax and inheritance tax, which is quite high. It was only applied in some regions in Spain, but today, after the law of the Impuesto a las Grandes Fortunas that was passed, rule only a couple of years ago, and applies since the year 2023, if I'm not wrong, then even non-residents and all the tax Spanish residents, even in all the regions as well, Madrid or Andalusia, that they were not subject to this type of taxes, they are subject to the wealth tax. And one of the benefits of this type of structures, it is the fact that can provide, in some cases, there are a lot of legal opinions out there, committed legal opinions, they can provide tax exemption on the wealth tax and inheritance tax.
Good to know, and it's a important thing in Spain. Let's see, more questions that we have. Yes, alternative investment funds are also suitable as a private undertaking versus collective?
That's a good question, because in the initial idea that everybody has of a fund is that it's a collective undertaking. Let's say it's something that someone, a promoter, has a project, an investment project, and he wants to onboard other investors. This being said, it can be used as well as a private vehicle. You can, for instance, open an umbrella entity in Luxembourg, and then you can have your own compartment within Arrive, or even in Spain, you can, let's say, set up an SCR and become the only investor in the fund. So there's no limitation in terms of number of investors, which is not the case for other type of vehicles. As you know as well, it has been quite recent in Spain. The CCAF now, which used to be the preferred vehicle for as a private solution for family offices, is not anymore valid for as a private undertaking, because you need to have at least 100 investors, each of them with a significant investment in the fund. So in the case of alternative investment funds, it can be suitable because there's no restrictions in terms of the number of investors.
Thank you so much. Another question that we have is, can you please elaborate again the case of the renewable energy fund that you mentioned before?
Absolutely, yes. This could be a good solution. On top, I mean, as you know, we have all these subsidies in Europe that favor this type of investments. So in this case, let's say a promoter in the US who has experience, who has track record doing this type of investments in the US, and he wants to expand geographically. He wants to onboard investors from Europe who has expressed interest to go along based on his expertise. So he can set up a fund. So a good alternative will be to open an SCR in Spain. Then if the investors, each one of them, invest more than 5% and have more than 5%, he will benefit on top of all the tax benefits that we just mentioned in the previous question regarding the wealth tax and inheritance tax. So he will pull the investors, the European investors, in the SCR to convert this entity into a fund, proper fund, regulated fund, and benefit from the tax advantages and commercialization to onboard. He will have to appoint a manager, a licensed manager, which could be Amicorp, for instance, but he will have control because he will be appointed as sub-advisor of the fund, and he will be the one deciding the investment projects he wants to invest in. These projects could be in Spain, but could be in any other European country or in any other third party country outside of the European Union. So he will create different SPVs below the fund. The fund will control these different SPVs. These SPVs could be financed through, let's say, senior loan at the level of the SPV. These loans could be non-recourse, which will mean that if one of these projects is not successful, the lender will not have, let's say, recourse to the fund. So will be non-recourse type of funds. And yes, I mean, each one of these projects will be managed individually. He can provide consultancy to each one of these projects as an additional kind of revenue for the sub-advisor. On top of that, as you know, in the European Union, there's a lot of regulation about sustainable investments, especially through the reporting of these investments. And all the funds in Europe, regulated funds, have to provide information about what is the approach of the fund in terms of sustainability. Based on these different types of approach that they will do to the sustainability of the investments, they can have like three different levels. Article 6, which means that they don't care about sustainability. Article 7, which means that they will take into account the sustainability criteria when they perform the investments, or Article 9, that means that the sustainability will be a very important criteria. Obviously, because this fund is investing in green energy, it will be quite easy that they get this Article 9, which is quite positive if they want to then market the fund among the investors in the future.
So, and again, to be clear, you mentioned that the projects, they don't need to be in Europe. There could be projects based in the United States, for example, or any other third country?
Any other third country, obviously that will require an analysis of the tax implications. As long there are double tax treaties between Spain, which in this case is where the fund will be located, and the country where the participating companies are located, there's a DDT in place. It's not a tax haven. They don't have, I said, not a low tax jurisdiction in which the corporate tax rate is below this, let's say, a standard rate of 10%. Yes, indeed, you can place the company and benefit of this tax treatment for sure. Yeah.
So, from your perspective and your opinion, in general, I mean, we don't need an in-depth analysis, but there is a trend of interest in the United States for developing renewable energy projects, especially since the Inflation Reduction Act provided several tax credits. So we are seeing a lot of appetite from developers from Spain coming into the United States to develop renewable energy projects. So the question is, from your expertise, do you need it would make sense for these companies set up a fund like this one that you mentioned, or you don't need to be so complex, and it would be better if the project is going to be in the United States or the projects are going to be in the United States, just set up the fund in the United States?
I think depends a little bit on the objective of the fund manager. For instance, if he wants to do onboarding of investors in Europe, it would be ideal to set up a fund in Luxembourg or in Spain, depending on the country he wants to do the marketing. But yes, that would be a good reason to set up the fund and do the onboarding of investors. Maybe he can place a fund in the US and then create a feeder fund in Europe that will invest. The only asset of this feeder fund in Europe will be the master fund in the US investing in these green energy projects in the US, because that will facilitate a lot the onboarding and the marketing of the investment strategy in Europe for him. Otherwise, if the manager, I mean, the assets will be placed in the US, 100% of the investors will be in the US. I mean, obviously we will have to analyze the situation, but maybe it makes no sense to have to, let's say, afford the expenses to have this structure in Spain, of the administration of the fund and so on, and to, let's say, pay to the investment manager. But if, as I said before, if he's willing to onboard investors from Europe, then it could make a lot of sense for him.
Very interesting. I think that's a very interesting point. So companies interested in bringing on more investors from Europe, this could be a very nice vehicle to redirect those funds, those investors from the European to assets in the United States. So
It
very,
could
very
be
interesting.
it
So
could be this structure in which the fund invests directly in the different projects in the US, or it could be if he has already decided to set up a fund in the US, which will be the master fund here, then he could open an SCS, for instance, in Luxembourg, as a feeder fund to onboard investors. He will be appointed GP, which means that he has control over the manager. The manager will be the one providing substance to the feeder fund and therefore capabilities to onboard investors. And that will provide as well a lot of comfort for the investors in Europe to know that they are regulated here. Yes, indeed. Both
wonderful.
options could be valid.
Perfect. Let me check if there's any other question. No, that was the last one, and it's 12:01. So we want to leave it for today. Thank you so much, Francisco, for your presentation. It's been a pleasure having you. We learned a lot of things, and in fact, we have a lot of information, useful information for investors. Thank you so much for being with us today.
Thank you, Juan Carlos, to you and the Spanish Chamber of Commerce for the opportunity. Thank you very much.
No, thank you. And the rest of you, thank you so much for staying with us. As we mentioned before, we will share the presentation, the video recording, and the contact information just in case you would like to get in deeper information with Francisco. And well, I hope to see you again in our next webinar or in-person event. Don't forget to check out our website, which is www.spainuschamber.com. And there you will be able to find out all our activities and events for the year. Thank you so much and have a great day. Goodbye.